Hello, everyone. My name is Todd Rosenbluth. I'm the head of ETF and mutual fund research at CFRA. I want to welcome you into our latest ETF webinar, ESG Approaches in ETFs. I want to bring in my guest, Arne Nowak of DWS. Arne heads up product development in the United States. Arne, thanks for joining us.
Thank you for having me, Todd.
So we're going to bring Arne back in, but I want to set up the stage on the next slide with the agenda of what we at CFRA are going to cover. I'll cover the ETF landscape, how ESG ETFs fit into that and the growing demand, the coverage that we at CFRA have of overall ETFs and how that contrasts to mutual funds. We'll bring Arne back in, as I mentioned, to have a discussion about recent developments in the ESG world, specifically the criteria that's used for some of the popular products out there. And then we'll come back in to talk just about the commentary and the research tools that CFRA has in this space. And then time permitting, we'll take as many questions of yours that we have. I believe you can submit questions directly onto the console. So please do so, and please engage with us here at CFRA. Now, the ETF pie continues to expand. It's nearly $4 trillion in assets. That's as of late May. But what we've seen is in the first 5+ months of this year, a lot of heavy lifting has happened within the fixed income space. More than half of the net inflows has gone into fixed income, but we are seeing pockets of growth within U.S. equity and international equities, despite the fact that the U.S. stock market has done very well, a little bit of choppiness in May. We've seen investors continue to put money to work across the various asset classes. On the next slide here, we're specifically talking about ESG today, and for good reason. We're seeing ESG assets climbing sharply. In the last nearly 18 months, we've seen more than 60% asset growth for ESG products. Now, it's off of a very small base, but we've seen the growth being stronger than in the traditional smart beta world. We're referring to smart beta as non-market cap weighted products. ESG would fall into that overall category. And we've seen a number of highly successful product launches help to drive the overall ETF flows. On the next slide here, here's a list of the 10 largest ESG-related ETFs. A couple of things to note here. One is that there's 2 products that launched in 2019 that are number 2 and number 3 in the overall asset base, jumping above some other products that have much longer histories, and I'm talking about USSG from X-Trackers and SUSL from iShares. Both launched within the last few months. Both gathered $1 billion faster than almost any all product in the history of the ETF world. And they are now coming close to catching up to a product that had a 13-year head start on them. Other things to note is that MSCI is the index partner behind a number of these strategies. We'll talk on upcoming slides the way that MSCI is scoring individual companies and the criteria that's there. We're doing that in part because we've got a guest from DWS, but also because MSCI is using similar criteria for various other products. And then lastly, I would note is that the more popular products have been the ones that are more diversified across the E, the S, and the G pillars as opposed to a singular pillar. So you'll see we've got SPY-X, a fossil fuel-free version of the S&P 500 index that obviously is going to have connection to the E, the environmental aspect of it. So is CRBN, the low-carbon product offered by iShares. Both those products have longer histories and have been jumped quite a bit from within. On the next slide here, even though we're going to talk about the growth that's happening within the ESG world, these assets, like any other ETF, they're not static. I touched on CRBN, the carbon product from iShares. That asset base has shrunk within the past year. SHE, a gender diversity product focused on making sure that there's equal representation or supporting companies that have equal representation within the governance part of the ESG landscape, has seen a reduction in these overall assets. And then Goldman Sachs came out of the gate very strong with JUST, an equity product, and the assets were relatively high when the product came out in 2018, and we've seen the assets shrink more than half the assets have left that product. Again, sometimes when there's institutional support, that institutional support doesn't always remain. On the next slide here, before we get into more of the discussion that we're going to have with Arna at DWS, a reminder of who CFRA is and our approach to analyzing ETFs. We have more than 1,200 equity ETFs under coverage, more than 250 fixed income ETFs under coverage. The way that we go about things is from a holdings-based perspective. We have a team of analysts that I'm sure you're aware of that do valuation and risk assessment of individual companies. We use that approach to analyzing stocks to help to drive our ETF research. And then we're combining that with fund attributes such as expense ratio, liquidity, other factors that are connected to the ETF. From a fixed income perspective, we're not going to spend much time on fixed income ETFs during this webinar, but if you want to learn more about the coverage we have of 260 fixed income ETFs, it's tied to the credit quality, the duration, and the yield of the portfolio. So a high yield bond ETF would score relatively poorly for its credit quality, but relatively favorably for its yield. And then that's combined with those fund attributes. The ESG related ETFs that we're talking about on this webinar, as well as other ones, are all less than 3 years old. We at CFRA cover them. More than 400 of our ETFs we have a rating on are less than 3 years old. Money is going into these products. You're interested in these products. We want to give you the tools to be able to have proper analysis. The bottom half of this slide just reminds you that we cover mutual funds too. A lot of money, in fact, more money is in ESG-related mutual funds. We have a similar but yet independent approach to rating mutual funds at CFRA, again looking at the holdings, again looking at the cost structure, but also inclusive of that relative performance record. Actively managed mutual funds, you want to recognize if there is skill in ESG-related ETFs, like we'll talk about here, or other smart beta-related products, is being outsourced. The selection of those securities is being outsourced to the index provider, and it isn't the discretion of the manager of that ETF. And so we don't think we should be looking backward when we're analyzing ETFs. On this slide here, shows you just a little bit more of that from a visual perspective. We are a peer of Morningstar's. We figure it's important to highlight how we're different than them. We use more forward-looking metrics, specifically on a holdings basis, as we do a rating of the ETF, and it also includes other cost factors. In the middle here, you'll see information about our equity research team that's behind the valuation and risk assessment of the companies. 75 analysts are doing the digging on individual stocks, and then we're using that to drive the overall rating. Now with that, let me pause here. We'll move to the next slide here. You'll get to see a picture of Arna and myself. I'm sorry you can't see the conversation in person, but thank you, Arna, for joining me again. Good to see you.
Yeah, pleasure to be here. Thank you, Todd.
So before we get deeper into the upcoming slides, maybe I'll let you introduce yourself and why DWS has a key role within the ESG space.
Yeah, great. Thank you for the opportunity. So myself, Arna Nowak, I am a managing director in the product team of DWS here in the Americas. DWS, as you may know, is the asset management arm, majority owned by Deutsche Bank. Our heritage, so to speak, is a very strong one in the sustainable investment space, in particular in Europe. We've been creating and managing client portfolios with an ESG angle since the 1990s. And as we'll sort of develop this conversation, you'll see that ESG actually means different things to different people. So we very early on discovered that there is a strong need for two things. One being data availability. So for the purpose of our broader portfolio management, we have built out a very strong research capability and data storage capability, where we in-house maintain a database of around 1 billion data points that relate to either E, S, or G related characteristics, stock characteristics, bond characteristics. And also, and that's a sort of more recent development, we have been launching here in the US a broad range of ESG related products, both on the mutual fund and in particular what we're referencing today and talking about today, a range of 4 ESG related equity ETFs that allow investors such as yourselves to slice and dice the global equity markets in a way that you're already being used to, but with an ESG angle.
That's great. So we'll move to the next slide here, but this is going to just talk about what E, S, and G stands for specifically, and then some of the key themes and then issues that MSCI is highlighting. But I think we've seen an evolution within the ESG space. It used to be as much of an exclusionary aspect. This shows you that some of the companies are being scored as much for inclusion for what they do or are doing favorably within the ESG space.
That's correct. It's I mentioned before already that ESG, or previously known maybe as SRI, social responsible investing, there's a lot of acronyms for similar things. And therefore, what we've seen is clients have a strong need for a certain level of standardization, certain level of transparency. And the slide that you show here actually makes a great attempt at doing so. So just for the avoidance of doubt, what does ESG stand for? E stands for environmental, S for social, and G for governance. And each of those three pillars is then filled with certain characteristics that apply to some, but not in all cases, all stocks. So for example, when we look at environmental scores, then there's certain things to consider around the climate, usage of natural resources, of course, pollution, and other environmental opportunities. And the social related aspects have more to do with human capital. And for example, and that might be a little bit more relevant in some of the more developing nations, how are workers allowed to organize themselves? How is labor being managed? And then the governance aspect relate to certain aspects around how the company is being run, how does the accounting work, what's the ownership structure. Todd, you already mentioned some sort of inclusion factors around board diversity, etc. So within each pillar is made up of a great variety of references and data references. And of course, not everything is applicable to every stock. So for example, financial stocks don't necessarily, for financial stocks, the water stress or water usage or toxic emissions isn't typically very relevant, but it is very relevant for, let's say, mining stocks or more heavy production manufacturing kind of companies. So therefore, what is important for us to always work with data that is relevant and adjusted according to the different sectors that are included in a portfolio.
Yeah, that's very helpful. We'll move to the next slide here, but I'm interested in being able to understand, you touched on it a bit of financials being an example of it versus materials, but maybe we can just talk about the way that MSCI is rating individual companies and how that might be different from an industry perspective as they're building the index, which is ultimately behind the ETF USSG.
Yeah, absolutely. So what you see here is an attempt to sort of give you on the line, the listeners, a little bit of insight into how MSCI work with regards to the ESG rating methodology. On our side, we've selected MSCI as a partner for our 4 ESG ETFs that are currently available in our range. The range is to be expanded, but for now, let's have a look at how MSCI works. So essentially, they, as I said before, screen every stock in the investable universe for the different E, S, and G related characteristics and apply a score, an aggregate score, depending on the outcome of that scoring. They do differentiate on an industry by industry basis for the reasons that I mentioned before. For example, water waste and general toxic waste not being applicable to financial stocks, but much more applicable to other sectors. So that sector characterization is done on MSCI's level. And what they then do is they essentially aggregate and standardize the different findings on a stock-by-stock level in the form of letter ratings that you may be used to in a more sort of credit rating context. But the nomenclature is very similar. So what you see here is those stocks that in respect of their individual industry groups score well on E, S, and G related characteristics tend to be scored on the higher side. So let's say AAA or AA scores, they tend to be known as the leaders. And conversely, if you look at those companies that don't do particularly well with regards to ESG ratings, they become known as laggards, or they sort of get grouped into the laggard categories. And then based on these categories, one can take those characteristics, take those scorings, and construct different portfolios on the basis of those scorings.
So we'll stay here for a second just to confirm this, because USSG has leaders within its name. That the ETF is more likely to have exposure to what we're seeing here on the AAA and AA rated from a leader's perspective. Is that a fair assumption?
That is definitely a fair assumption. It is literally, the clue is in the name. The USSG, the MSCI leaders, as well as EASG, EMSG, or ACSG, all focus on the leaders of their respective universe, and I think we'll go into the detail a little bit.
Yeah, and so we'll move to the next slide for an example, but I was remiss. I was so excited to be going forward on the webinar that I didn't let the audience know that we are recording this, and that a link to the recording will be made available within the coming business days. Apologies for that. So what we're showing here, and we'll show on an upcoming slide as well, is these are companies that are not necessarily in the portfolio, in fact, that we're talking about, because they have relatively low ESG ratings from MSCI. So we'll move from what used to be Valiant Pharmaceuticals, which is now Bausch Health Companies, and show you another example here on the next slide of Equifax on the slide, and maybe, Arne, you can just highlight how this fits in from your perspective.
Yeah. So Equifax, or this is just one example that is available from MSCI's universe. At the time when the data breach was revealed, when the company struggled with that, the company had previously been screened out from the ESG index universe, and therefore the underlying index did not actually have exposure to the challenges. So there's a couple of examples that, if you're interested, one can go into quite a great level of detail, but the idea really is of ESG screening not to be purely let's say a feel-good factor, but really be a factor that is used for the purpose of prudent investment management. So in this case, certain concerns and flags were raised from an ESG perspective, in particular from a usage of data, a data security standpoint, and Equifax at the time did not make the cut from an ESG ranking perspective, and turns out, with hindsight, of course, that screening out was advantageous for possible in terms of possible exposure to the company, because the index did not have exposure to that company in particular.
Yeah, and I think in hindsight, governance is one of those things people realize after the fact. The public necessarily can spot this, and of course, but the true efforts behind ESG efforts is catching these in advance, and that it can have real stock implications as well. We'll move to the next slide to just highlight. I talked about ESG as part of the broader smart beta world. Smart beta is used and thrown around quite a bit. Helpful to just understand how that fits in overall. So we are showing on the slide here SPY, which is the Spider S&P 500 Index ETF, largest, oldest, most liquid ETF that's out there, and its exposure to Microsoft and the technology sector. We're using that as a starting point for this. I'm including on here a smart beta, a multi-factor smart beta ETF from JP Morgan. That's JPUS is a ticker. The JP Morgan Diversified Return US Equity ETF, and then USSG, which we've been alluding to, and now we can have more specific reference to. So you can see there is a overweighting or heavier weighting to Microsoft and to the technology sector within USSG. Among the top 10 holdings, you'd also, in USSG, one would also find Visa and MasterCard and Cisco. But you would not necessarily find, even though it's no longer in the technology sector, you would not find Facebook, for example, within the larger holdings within this product. JPUS is a more, even though it has 450 stocks, which is in the same ballpark, Disney is its largest overall position at 60 basis points. it's no longer in the consumer discretionary sector, but the consumer discretionary sector is the largest at 16. Microsoft is part of JPUS. It's just 50 basis points weighting. So again, individual stock selection really comes down to the rule book that's being used, how ESG fits into the smart beta. You should not just be saying, I'll buy a smart beta product, or I think I'm going to buy more smart beta products for my clients. You really need to understand the rule book that's being done behind this. Arne, anything you want to highlight on this in terms of how USSG is positioned?
Yeah, what I would say is you make a great point that ESG and smart beta, the broader smart beta category might include ESG, but it's actually very different. The aim for the typical ESG product that you find out there isn't to be cleverer, so to speak, than the market from a performance or risk standpoint. It is very much to provide market exposure, but with that ESG lens. So it's a bit of a different angle. And of course, you highlight that the IT sector is slightly overweight here. What I would say, however, and we'll go into that in a little bit more detail, the aim is generally for USSG to have a very broadly diversified sector weighting and sector portfolio where the weights are in line with the respective benchmark weights.
Well, and thanks for that. We'll move to the next slide here about the index construction that's behind USSG. And again, I believe the leaders construction is also, index construction is similar in concept with the other products that DWS has that are tied to the MSCI benchmark. So we're covering a few products overall, but I'll let you speak to this slide as to what is really happening from an inclusion and an exclusionary basis.
Yeah, and I'm glad that you mentioned that. So yes, the methodology for the MSCI leaders indices is the same, no matter whether you look at a pure US universe in the case of USSG, or an EM universe in the case of EMMG, EMSG, sorry, the methodology is the same. So the way it works is it typically starts with something that is a little bit more well-known, with some exclusion of controversial business activities. So in the case of the leaders indices, they screen out stocks that have exposure to alcohol, to controversial weapons, gambling, civilian firearms, tobacco, just to name a few examples. So certain controversial activities are being excluded from the underlying index. The let's say meat of the methodology, however, is the second step that you see here. So on the right hand side, what the colors depict is intended to be the leaders to laggards methodology that we observed a couple of slides previously. So in the dark green, you see the AAA, they're very much in the leaders category, and the lighter green is the AA, also both of those categories being very much on the leader side in their respective industry groups. And then in the darker color schemes, the orange and the red are the laggards. So what you see here is that any investment universe, so let's say the MSCI USA Index in USSG's case, each of the sectors, the traditional geek sectors, get ranked from the leaders down to the laggards. So for consumer discretionary, what are the stocks that fall into the leaders categories? What are the stocks that fall into the laggards? The same for consumer staples, energy, financials, and so on and so forth. What then happens is there is a cutoff point that is given by the index methodology at 50% of the market capitalization for the respective underlying index, or for the respective sector in the underlying index. And then the index goes from top to bottom, so includes all of the leaders and all of the companies that score well on the respective ESG scale within each sector until 50% of market capitalization is included. So to speak, a positive inclusion in the index, or a best-in-class approach. And what is not included is the bottom 50% in terms of market capitalization. So what the index does not focus on is the laggards. And what you only have included positively in the MSCI leaders indices are the leaders in terms of ESG of the respective underlying sectors.
So thanks for that, and that sets the stage quite a bit. We covered a lot of ground, but on the next slide here, a few things that I think are worthwhile to understand from an advisor's perspective. from an ESG aspect. So historically, I found that ESG ETFs were not in favor with advisors, with investors, in part because they were either staying loyal to their mutual funds, and they didn't see a reason to make the change because cost, which is unfortunately, in my opinion, a huge driver for the flows into ETFs. Cheaper products are winning out. We're seeing that come to the ESG world as well. And so now all but one of the 10 most popular ESG ETFs, the ones with the most assets, have an expense ratio of just 25 basis points or less. It actually is 10 basis points for USSG, which is extremely cheap. For perspective, SPY that we were highlighting earlier is 9 basis points. Yes, there are cheaper alternatives to the S&P 500 index, but it's still the largest ETF for a reason. And so we think that lower costs shall help get people in the door, at least to pay more attention to these products. In fact, you can get USSG or some of the peers within the ESG space for less than you can get traditional smart beta products that have considerably more assets. So asset managers like DWS and others are really putting their scale to work here. We touched on earlier about the review process, or Arne talked about the review process from an index perspective. These are not static portfolios, and unlike the market cap weighted S&P 500, the index rebalances. Arne, it rebalances quarterly for USSG?
Absolutely.
So even though much may not change, the constituents may not change, the overall weighting would do so, and companies are going to, red flags are going to pop up for individual companies, and so something that was a leader at one point, the criteria may be no longer met. And so again, due diligence is required and is important. And then lastly, even though we've spent the time talking about USSG and or other US specific oriented ETFs, we saw on that prior slide of top 10 most popular products in developed international and in emerging markets products from iShares, with iShares as well as Vanguard as well as DWS, you can get diversification on a global perspective. Arne, do you mind just repeating the tickers? You said them earlier for the all country world, the EFA-based and emerging market products in DWS?
Yeah, absolutely. Our system is always SG at the end. So US SG is for the US, AC SG is for the all country world ex-US, EM SG is for emerging market, and EA SG is for the EFA product.
Great, I appreciate that. So on the next slide, again, about us from CFRA's perspective, on the right-hand side of the screen is a sample report or a screenshot of a sample report for USSG, since we've been spending time talking about it, wanting you to understand that we cover it, even though it is roughly 3 months old, and how we go about covering it. So if you've seen our reports beforehand, they're end user very friendly. Green is contributing favorably, yellow is neutral, red is contributing unfavorably to the overall rating. We cover over 1,200 equity ETFs, over 250 fixed income ETFs, and we're excited to be covering the landscape that DWS offers in the ESG world, and perhaps soon we'll be covering down the road. On the left-hand side is an example of thematic commentary that our research team publishes throughout a given week. We talked about in a prior webinar actively managed ETFs and whether we may be seeing more of them from the traditional mutual fund world. I find that the most popular topics that I write about here at CFRA have American funds in the title. So this is an example of one of those pieces, whether American funds might soon launch an ETF. We publish a range of topics. We published earlier in the month about ESG investments, and I think we'll be including that in the follow-up to folks, but you can be able to view that ESG research commentary from CFRA on the MarketScope Advisor platform today. So we'll move here to the next slide. This is another feature that we offer to our clients of MarketScope Advisor, is as much of a push of our thematic commentary, commentary from myself, from Sam Stovall and Lindsay Bell of our investment strategy team. Commentary from our stock analysts and our industry experts are here, as well as tips and tricks of how to better use the platform. This is a newsletter that comes out on Tuesday. If you're not receiving this and you'd like to receive this, again, in the Q&A box, please share your contact information. We'd be happy to push the latest commentary that we have onto you on an ongoing basis. And we'll move here to we'll pause here to take some of the questions that have come in. Arne, the one that I want to highlight with you, we'll start off with, is the USSG product came out of the gate very strong. I believe that a institutional investor in Europe started with a nice funding behind this, but we're here talking to a wealth management audience. How has it been going within wealth management in awareness, and what are you hearing from advisors?
Yeah, so what I would say, broadly speaking, is in terms of regional comparisons, the US is a little bit behind the ESG conversation when we compared with Europe as a broad region. In particular, the people that we've seen very interested in the conversation for a number of years now are European, and in particular from the Nordics, institutional investors. And as you highlight, we've had a great partnership there from this region. However, the US, in particular the US wealth management space, is catching up fast. We see a number of IRAs, we see a number of broker-dealers work or already having launched model portfolios that are akin to the standard model portfolio, standard asset allocation, but with an ESG angle, and sort of that has driven us, and that has led us to actually launch the range that you kindly allowed me to highlight earlier, Todd, in terms of actually empowering people to stick to their traditional asset allocation process, but fill those buckets of US equities, EFA equities, or EM equities with an ESG lookalike product at core prices. So, for example, our EM product is priced at 20 basis points, or our EFA product is priced at 14 basis points. So, again, we wanted to bring that core exposure at a core price with an ESG lens to the market here in the US.
Thanks for that. Another question that came in, which I'll take, is how CFRA looks at ESG ETFs. Do we rate them from an ESG perspective? Do we have favored ESG ETFs? The short answer is we do not. We rate all equity ETFs using the same universal approach, looking at the underlying holdings from a valuation and risk perspective. So we cover Microsoft, we cover Disney from a analytical perspective. Our analysts are certainly thinking about governance as part of the research that they have, and from a forensic accounting perspective, that's a highlight that what we at CFRA have that differentiates us from other research firms, as well as independent research firms in particular, but we don't have a current grading system that is tied to ESG today. But we're certainly aware that the universe continues to expand, and our research will look to expand to better serve our clients. I want to move through I'll come back to do another question or two in a moment, but I don't want to forget this. I forgot something earlier, so apologies. So we have a webinar coming up within our broader research team talking about the Canadian commodity climate. We cover a range of individual Canadian stocks. We'll be having a webinar on June 20th at 1 p.m. A link to register for this webinar will be provided shortly, and you can find out more about our coverage of individual Canadian stocks at MarketScope Advisor. And you can see the bottom here of how to register for this yourself. It's a pretty simple URL, go.cfraresearch.com/Canadian-equities. I'll move to the disclosure slides as I thank Arne, but I'll have another question for Arne. We'll move forward onto the next couple of slides here. But Arne, I believe that DWS has also filed for an S&P or an S&P index-based ETF tied to ESG. Realizing that it's in the filing and not live product stage, anything you can share with our audience on this?
Yeah, you're right. Our filing has in fact gone effective with the SEC. The filing is on the S&P 500 ESG index. So we're actually super excited to be partnering with S&P on their key benchmark, which hopefully everyone who's on the call will recognize. The characteristics of that portfolio will be very similar to the S&P 500 standard index with an ESG lens, and that product we are looking to bring to market at the end of June.
Oh, that's great. It's exciting since, again, more choices for investors to be able to compare and contrast. And again, even though we spend a lot of time talking about the MSCI criteria behind ESG, the criteria that's being used by S&P for inclusionary purposes is going to be different. Requires that investors and advisors do a little bit of homework as they dig into the various products that are out there. So thanks for providing that perspective. With that, I'm going to thank Arne for joining me again for this. Thank you for your questions. Thank you for listening. Please tune in again to the next webinar that CFRA has on June 20th, focused on Canadian equities, and we'll be in touch going forward. Thanks again for your time.